Late 2025 presented a hostile operating environment. Sticky inflation and a sluggish job market placed severe pressure on consumer wallets, grinding the broader retail sector to a near halt. Against that economic friction, Five Below reported a headline revenue jump of 24.3%, reaching $1.73 billion for the fourth quarter. This chart visualizes the anomaly. While the broader industry baseline remained flat or declined, Five Below's trend line detaches, peaking at a 15.4% comparable store sales increase during the critical holiday quarter. Comparable sales, or comps, is a metric measuring revenue growth exclusively from locations open for more than a year, stripping out the artificial top-line boost of new store openings. That revenue surge flowed directly to the bottom line, resulting in a 24% increase in adjusted EPS to $4.31. EPS, or earnings per share, is a company's net profit divided by its outstanding shares of common stock, serving as the ultimate indicator of profitability. A 15.4% comp in this environment is a statistical outlier. This holiday performance suggests that Five Below's growth is now tethered to a specific set of operational shifts that merit closer inspection. To understand the mechanics of this growth, we have to examine three specific operational drivers. The first is a total overhaul of the company's pricing architecture, designed to expand unit revenue. The second driver is a hard pivot away from traditional marketing toward a highly agile social-to-store acquisition flywheel. The third driver is management's aggressive defense of operating margins against severe external supply chain pressures. We will reverse engineer the Q4 comparable sales stack to understand exactly how these three pillars interact at the unit economic level. Mastering the mechanics of this specific operational model is mandatory for investors looking to evaluate the durability of Five Below's multi-year growth projection. This vertical bar represents the 15.4% Q4 comp. We split this metric into its core components. First, 8% of this growth was generated by an increase in ticket size, meaning customers spent more per transaction. The remaining 7% was driven by an increase in foot traffic. Generating near equal, high single-digit growth in both ticket size and foot traffic simultaneously is a mathematical rarity in retail. It proves the revenue jump was fueled by broad-based consumer demand, rather than relying solely on inflation-driven price hikes to mask declining store visits. Retailers built on extreme value propositions face a structural trap. Raising prices past a namesake limit risks alienating the core customer base. This blueprint shows Five Below's historical approach, quarantining higher-priced items in a dedicated Five Beyond section at the extreme rear of the store. In Q4, management pivoted. They dissolved this segregated section entirely, integrating $7, $10, and $15 items into standard category aisles where customers shop. Instead of forcing a customer to walk to the back for premium tech, they placed a $10 speaker directly next to a $5 charging cable. This adjacent placement forces the consumer to evaluate the relative value of the premium item in real time. This pie chart illustrates the defensive counterweight to that strategy. To protect their core value perception, the company engineered their inventory to maintain a strict 80% unit mix of items priced at $5 and below, ensuring the primary price entry point remained intact. By merchandising based on native category logic rather than artificial price ceilings, Five Below organically expanded their average unit retail without triggering a customer revolt. Average unit retail, or AUR, is a metric tracking the average price an item is sold for across the entire store. Driving the 7% increase in foot traffic required the company to abandon their traditional playbook of static seasonal merchandising and television ad spend. They re-engineered their customer acquisition cost model by redirecting capital toward creator-driven social media, specifically targeting Gen Z, Gen Alpha, and millennial parents. Customer acquisition cost, or CAC, is the total expense a company incurs to convince a new consumer to buy its product. Instead of guessing what might be popular months in advance, the company tracks user-generated viral moments, like the Q4 squishy dumpling craze, and dynamically amplifies that content in real time while stocking the corresponding inventory. This architecture shifts marketing from a passive one-way broadcast into an active two-way community engagement loop, utilizing customer databases to direct personalized content. This highly agile flywheel allows their supply chain to monetize digital trends instantly. By matching social velocity with inventory execution, They drove massive foot traffic across both new and existing customer cohorts. This waterfall chart tracks the Q4 margin threat, a 160 basis point drop caused by global tariffs. Management neutralized this threat at the item unit level through aggressive vendor negotiations, product reengineering, and surgical pricing, offsetting costs penny for penny. They then added a 50 basis point improvement by reducing inventory shrink. Finally, massive fixed cost leverage from top-line comp velocity absorbed their investments in peak period store labor, pushing the full-year adjusted operating margin to nearly 10%. Top-line revenue velocity is mathematically useless without operational discipline. This margin defense proves the resilience of Five Below's unit economics under duress. This chart maps baseline targets for fiscal 2026. Management guides net sales to $5.2 to $5.3 billion, driven by comparable sales of 3% to 5%. Despite conservative constraints against massive back-half comparisons, they project a 10.9% EBIT margin. EBIT isolates profit from core operations. Rather than letting the Q4 cash sit idle on the balance sheet, management is executing an aggressive capital allocation pivot. Capital expenditures are stepping up to roughly 4% of net sales, totaling between $230 million and $250 million. That capital is flowing into three specific channels: funding approximately 150 net new stores, expanding distribution network capacity, and upgrading their technology infrastructure. Management is deploying peak free cash flow back into the business. By funding infrastructure now, they are scaling their capacity and store footprint before competitors can adjust to the new pricing architecture. The company's structure has shifted. They have replaced the rigid, price-capped discount model with a specialty retail framework that reacts to trends in real time. Integrating higher-priced items directly into native categories expanded the average transaction size without alienating the core customer base. Simultaneously, their precision execution of a social-to-store funnel, combined with relentless item-level margin defense, proved they can operate profitably in a hostile macroeconomic climate. By combining extreme value discipline with a socially connected pricing architecture, Five Below has established a growth model that remains resilient across shifting economic cycles.